Let's get right to the floor show and Doubleline's Deputy Chief Investment Officer, Jeffrey Sherman. Jeffrey, what's really impressive, I think, about the Dow's, 337-point gain right now is that it's holding up even after Atlanta Fed President Raphael Bostic told an economics club luncheon crowd in Atlanta he favors no rate cut at the Fed's final meeting of the year next month. He wants to see clear evidence of inflation moving toward the 2% target, and that, quote, we cannot breezily assume inflationary pressures will quickly dissipate after a one-time bump in prices from tariffs. Now, let's be clear, Jeffrey, he's a non-voting member, but game for us what the voters, I'm talking about the Fed voters, will do. Gotta clarify that.
At this point, at this point, we have to reference what Mr. Powell said a couple of weeks back, and that's when you're in the fog, you need to slow down. And so I think that's kind of the unknowns here with, are we going to get the October payrolls data and inflation data? It looks like now it's a no. How long is it going to take for us to actually get that data? And so if we're in the fog, probably patience is the right thing. And I think what Mr. Bostic is talking about in this scenario is that he's witnessing goods inflation, starting to creep into the series. There was a nice report on rents today that was somewhat negative that could put some pressure on the housing component of CPI. But ultimately, we're seeing that rising component from goods. And when we look at the data, that's been collected in duties and levies as of late, we've been running for the last 3 months north of 30 billion a month, and last month was at 35 billion. And so what that tells us here at Doubleline is that, we are starting to see the tariff policy actually hitting the border, which means that it's going to hit our supplies chain at some point in the next X number of months. And I have to throw the variable X there because we don't know if that's going to end up at the price level, at the retail level. Does it end up somewhere in the supply chain through distributors and the like? So I think what Raphael Bostic is talking about here too is a rightful idea, because if the Fed cuts rates too prematurely, we could ignite these animal spirits that we've seen as of late. Since the last two Fed cuts. So I think we still are in a big uncertainty. And just because we have the potential for the government to reopen after tonight, it's going to be a while before we get this backlog of data through the system as well.
Yeah, and no guarantee that, as you said, we'll get any of the data that are very heavily delayed. We're looking right now at the Dow Jones Industrials, which clearly is about to see its first close above 48,000. Is the disconnect there? Does it tell you, does it guide you at all with the markets jumping to record highs and a little bit of concern about inflation still there? But again, the question mark is what the jobs market truly looks like. We just got the ADP number, which was a minus 11,000 and change. Does it guide you into certain investments? And if so, where?
Yeah, I think what you have to think about right now is that, from the labor market component, we've seen the demand side decrease, and that's undeniable. That trend's been underway for at least 6 months. But the question is, what's happening with the supply of labor as well? And we've seen dissipation on that side, a lot of it due to, just having a negative net migration this year. And so we have a challenge with the overall labor market, because even if we stay in balance and, demand and supply are softening together and we stay in this weird equilibrium, well, it probably portends for lower growth rates. So I think the way that people have been thinking through this, and rightfully so, is that, it's starting to, buy into kind of the interest rate component. You don't really want to step into really the most interest rate sensitive parts of the market. But, in that kind of middle of the yield curve, the 5 to 10 year part of the curve looks pretty attractive. And there's investments that work there, right? You talk about blue chip names, things that, are very popular in the bond market today that are very stable are investment grade corporate bonds, right? That can be a core piece of lever to have in the portfolio that balances that part of the interest rate risk as well. So we've seen things like the government guaranteed mortgage sector get really cheap this year and continues to be a very strong performer. So I think there's ways of investing in a bond portfolio where, one, you don't have to double down on your equity risk, but more importantly, you don't have to take meaningful risk to generate, these 5 to 5.5% type of cash flows in the market. And if you want to take a little bit more credit risk, you can step into that 6.25 range. So in general, I think there's still return opportunities that are offered by the bond market and not having to stretch to the high octane parts of the market today.